Okay, let's unpack a truly novel approach to shareholder value today.
Definitely something different.
Imagine a publicly traded company announcing a dividend. Okay, pretty standard. But what if it's not in cash? What if it's in Ethereum?
Sounds pretty futuristic, right?
Right.
But it's happening now.
Exactly. It's not just some concept. BTCS Inc. just went ahead and did it. And, well, it's sending ripples across the financial world.
Big ripples.
So today we're embarking on a deep dive. We're looking at this fascinating convergence, traditional stocks meeting cutting-edge blockchain tech.
Yeah.
Our mission to really dissect what this groundbreaking Bividend, that's their term, actually means, why a company like BTCS is taking this frankly pioneering step, and maybe most importantly, it could signal for the future of finance and, your own investment strategy.
And what's really fascinating here, I think, is we're seeing a very tangible, concrete example of digital assets starting to actively reshape conventional financial mechanisms.
Right, not just theory anymore.
Yeah, exactly. We've pulled together insights from, well, a whole range of sources for you. Yeah. Financial news desks, tracking the market moves, deep dives into the crypto tax side of things.
Which is crucial.
Oh, absolutely. And also the broader discussion around tokenized securities. So we'll explore the what of this move, the why behind BTCS's strategy, and then, like you said, the big so what for you, the curious investor.
So let's get into the specifics. How does this actually work? It's not just like sending a few random Satoshis out.
No, it's structured.
BTCS rolled out this unique two-part Ethereum dividend program. It seems designed to do a lot more than just distribute funds. What are the nuts and bolts here?
Okay, so August 18th, 2025, that's the date they announced it, BTCS said they'll pay shareholders a one-time blockchain dividend.
The Bividend.
The Bividend, yeah, they cleverly coined that. It's 0.05 size per share. And here's the interesting part. You can choose. Get it in Ethereum, ETH, or if you're not comfortable with that, just take regular cash.
That choice is key, and it's the first time a public company's done it specifically with Ethereum.
First time ever for an ETH-specific dividend from a NASDAQ-listed company, yeah. A real milestone. But they didn't stop there.
The second part.
Right. To really incentivize, long-term commitment, maybe reward loyalty, they're offering an additional one-time $0.35 per share loyalty pay.
Okay, $0.35 more.
But this one is payable solely in Ethereum. No cash option for the loyalty bonus.
Wow, okay. So if a shareholder goes for both, that's potentially $0.40 per share, all landing in their ETH wallet.
If they opt in and meet the requirements, yes.
That's a pretty significant chunk, clearly designed to encourage, something specific. How does someone actually qualify for that bigger loyalty payment? What are the hoops?
Right, there are a few specific steps. First, shareholders have to transfer their shares to what's called book entry.
Okay, what does that mean for the average person?
It essentially means registering your shares directly with BTCS's transfer agent. That's equity stock transfer in this case.
Yeah.
So you're bypassing your usual brokerage firm, holding the shares directly with the company, more or less.
Got it. Direct registration.
Then you need to hold those shares there in book entry for at least 120 days, specifically right through January 26, 2026.
So a holding period requirement.
Exactly. And the record date for both the base $0.05 Bividend and your eligibility to even start that 120-day clock for the loyalty payment is September 26, 2025.
Dates are important here.
Very. And crucially, you have to actively opt in. Go to their site, bividend.com, say you want the ETH, provide a valid Ethereum wallet address. If you don't do that,
You just get the nickel in cash.
you just get the $0.05 cash dividend, correct? And one other point, company officers, directors, employees, they're not eligible for that extra $0.35 loyalty payment.
Interesting. So it's purely aimed at external shareholders.
Seems that way. Really underscores its purpose as a shareholder incentive, maybe even a defensive one.
This definitely sounds way more involved than just getting a check in the mail. It suggests this isn't just, a simple payout. It feels like a very calculated strategic move.
Oh, absolutely.
Charles Allen, the CEO of BTCS, he didn't really downplay it. He called it more than just another dividend, even a shield for loyal shareholders. What's really driving this? What's the strategy?
Well, if you connect the dots, BTCS is positioning this as a kind of promise, a show of trust, maybe, but also a direct way to fight back against market manipulation.
How so?
Allen explicitly said that by encouraging investors to move shares to book entry, that direct registration we talked about, it severely limits the ability of what he called predatory short sellers to borrow those shares.
Ah, because the shares aren't sitting with brokers easily available for lending.
Precisely.
Ah.
It makes it harder to short the stock. He literally said, our loyalty program fights back. So it's not just talk. It links to a bigger effort to stabilize their stock price.
And they felt the price needed stabilizing.
Apparently so. BTCS pointed out this, well, significant disconnect. As of mid-August 2025, the company held about $6.65 per share in cash and digital assets, mostly ETH, obviously.
Okay, $6.65 book value, roughly.
Yet its stock was trading around $4.41. That's a big gap. They clearly see their stock as undervalued.
That is a considerable gap. So this Bividend is doing double duty. Rewarding shareholders, yes, but also acting as a defense mechanism, protecting the company's value from, external pressures like short selling.
Exactly. You nailed it.
Is this kind of defense common? I mean, how does it compare to traditional methods companies use against shorts?
Well, traditional finance has tactics, right? Share buybacks, maybe special cash dividends to signal confidence and return value. But this BTCS move is pretty unique because it leverages the nature of blockchain and crypto.
How so?
It's symbolic of their whole strategy. BTCS is a US-based blockchain tech company. Their primary focus, Ethereum. They've put their money where their mouth has bought $60 million worth of ETH for their treasury earlier.
Right, they hold a lot of ETH.
Over 70,000 ETH currently, valued at around $300 million. So this dividend program isn't just returning value, it reinforces their identity as a major Ethereum advocate among public companies.
So it's brand reinforcement too.
Definitely. And it aims to boost shareholder participation by literally drawing them into the Ethereum ecosystem, while simultaneously making life harder for short sellers by locking up those shares in book entry. It's a real statement of conviction.
Conviction in their own business and in Ethereum itself.
Precisely.
In that conviction, it seems, struck a chord with the market. How did investors actually react when this news broke?
The reaction was pretty immediate and quite positive.
Yeah.
After the announcement, BTCS shares, they surged. Closed up 7.37% that day, hitting 4.7350 cents.
Okay, a decent jump, but what does that really tell us? Was it just hype, maybe retail investors jumping on something novel, or something more?
That's the question, isn't it? While some retail excitement is likely, the size and speed of the move suggest maybe something deeper. Perhaps the market is starting to differentiate.
Differentiate how?
Between companies that just passively hold some crypto assets versus those, like BTCS seems to be trying here, that are genuinely innovating, integrating blockchain into their core financial operations, like shareholder distributions.
So rewarding actual innovation in tokenized finance.
It could signal that, yeah. A sign that the market's maturing, maybe, in how it views crypto integration beyond just balance sheet assets.
That immediate jump definitely makes you wonder, is this just a one-off thing for BTCS, or are we seeing the beginning of something bigger? Like this whole trend towards tokenized securities.
It certainly feels like part of that broader trend.
What exactly are tokenized securities? Are they really becoming common?
So tokenized stocks, in simple terms, mean your ownership of a traditional stock like Apple or, well, BTCS is represented and tracked using blockchain tech.
Instead of the usual way.
Right. Instead of just an entry in your broker's database, you hold a digital token in a digital wallet, like holding Bitcoin or ETH. It's a blend of the old stock world and the new crypto world.
And is this catching on?
It seems to be gaining traction, yeah. You've got players like Kraken with their X stocks,
Sure.
Robinhood offering tokenized stock trading over in the EU.
Smaller players, maybe crypto native ones.
Some, but also look at the big institutions. BlackRock, Franklin Templeton, Goldman Sachs, BNY Mellon. They're all actively exploring or even offering tokenized versions of things like money market funds.
Wow, the big guns are involved.
Definitely. And the industry promotes a lot of potential benefits. Things like better accessibility through fractional shares.
So you can buy just a small piece of an expensive stock.
Exactly. Potentially lower transaction costs because you might cut out intermediaries. More transparency, supposedly enhanced security from the blockchain's immutable record.
And things like 247 trading, instant settlement.
Those are the promises, yes. The potential upsides that the proponents really push.
Okay, those benefits sound, well, pretty compelling on the surface, a new era of efficiency, access. But I can already hear some skepticism. Are these real fundamental improvements, or is it, like some critics argue, just old wine in new bottles, new tech wrapping existing ideas?
That's a really important counterpoint.
What are the potential downsides, the hidden complexities here that maybe aren't getting as much airtime?
It's crucial to look at that. Well, the crypto industry hypes the benefits. Critics like Professor Hillary Allen from American University, for instance, they raise some serious flags.
Such as?
Well, for one, many of the touted advantages, like fractional shares or commission-free trading,
We already have those with many traditional brokers.
exactly, they already exist.
Hmm.
So is tokenization really necessary for those? The core issues critics point to often lie in the risks of the underlying tech and the still evolving regulatory picture.
Like what kind of risks?
Things like potentially irreversible transactions send tokens to the wrong address, and they might be gone for good.
Yeah.
There's uncertainty about legal protections. Who is the issuer legally? What happens if the platform holding the tokens gets hacked?
Big questions.
Huge. And smart contracts, while powerful, can be inflexible.
Yeah.
They might not cover every unexpected situation. Plus, there's a significant worry that tokenization could be used, intentionally or not, to sort of sidestep existing investor protection laws.
Which could erode trust.
Potentially, yeah. Undermine trust in the established financial markets. So the argument goes, for some players, the real motivation might just be getting crypto deeper into traditional finance rather than fundamentally making things better for the average investor in every single way. It's definitely nuanced.
Right, not a simple better or worse. It puts a different spin on it. Okay, so shifting back to the investor experience. For someone used to traditional stock dividends, maybe getting a few percent yield each year, how do these crypto payouts, like the Bividend, really stack up against other ways to earn passively in the crypto world, like staking or yield farming?
That's a great comparison to draw.
What are the risk-reward trade-offs that you, the investor, really need to be thinking about?
Okay, so both approaches, earning crypto via dividends or staking versus traditional stock dividends, they're both forms of passive income, right? But they have very, very distinct profiles. Crypto staking, where you lock up your crypto to help secure a blockchain network, often boasts potentially much higher returns. We're talking averages, maybe over 5% annually. But some protocols, especially DeFi, can aim for 20% or even more.
That's significantly higher than most stock dividends.
Generally, yes. Typical stock dividend yields rarely top 6% per year. Plus, many crypto networks have these burning mechanisms, where they destroy some tokens, which can potentially help offset the kind of price dilution you sometimes see with traditional stock dividends when new shares are issued.
Okay, so potentially higher returns on the crypto side, but that never comes for free, right? What are the big trade-offs, the risks you absolutely have to weigh?
The primary trade-off, and it is a big one, is risk, specifically volatility.
Crypto prices can swing wildly.
Exactly. Far more than traditional stock markets, usually. Those potentially high-staking returns come hand in hand with the possibility of your underlying crypto asset dropping significantly in value. Plus, staking often involves lockup periods. Your funds might be inaccessible for days, weeks, even months. That's a problem if the market tanks and you want to sell, or if you just need the cash.
Liquidity risk.
Precisely. And then there are the tech risks, vulnerabilities in the smart contracts, the potential for hacks. While rare in traditional markets, we've seen major hacks in the crypto space, unfortunately.
So higher potential upside, but significantly more risk effectors.
That's a good way to put it. On the flip side, traditional dividends from established companies generally offer much greater stability and liquidity. You can usually sell your stock anytime the market's open.
But they're not risk-free either.
Not at all. Companies can and do cut or even eliminate their dividends, especially during economic downturns. And like we mentioned, stock dividends can dilute the share price over time.
So for you, the investor listening,
It really boils down to your personal risk tolerance. How much volatility can you stomach? And what are your investment goals? Are you seeking stability or maximizing potential returns? Some people might find value in diversifying, having a bit of both.
balancing the potential crypto growth with the stability of traditional dividends.
Could be a strategy for some, yeah.
Okay, beyond the investment mechanics, the strategies, the risks, there's a very practical, sometimes intimidating aspect we absolutely have to talk about. Taxes.
Ah, yes, the tax man cometh.
For a U.S. investor, how does the IRS, the Internal Revenue Service, actually view these crypto dividends? This is where a lot of the cool tech meets, well, real-world paperwork and complexity.
Indeed.
Yeah.
Let's move from the theory to the very practical. Taxes are critical here. The official stance of the IRS is clear. All cryptocurrency, including Ethereum, is treated as property for tax purposes.
Not as currency, like dollars.
Correct.
Yeah.
Property. And that designation has big implications. It means earning or receiving crypto, whether it's from mining, staking rewards, or a dividend like this Bividend, is a taxable event.
Just getting the crypto triggers tax.
Yes. The moment you receive those coins, the fair market value in US dollars on that date is considered ordinary income. You have to report it. It's basically treated as if you received cash and immediately used it to buy the crypto from a tax perspective.
Okay, so income tax on receipt based on the value that day. What about later? If you decide to sell it or trade it for another crypto or even, I don't know, use it to buy a coffee.
That's a separate taxable event every single time.
Wow.
If you later sell, trade, or dispose of your crypto, including using it to buy goods or services, you'll likely trigger a capital gain or loss. You compare the value when you sold or used it to the value when you received it, your cost basis.
And that gain or loss gets taxed differently.
Correct. It depends on how long you held the crypto. Less than a year. It's a short-term capital gain or loss taxed at your regular ordinary income rates, which can be up to 37%.
Oh.
Held it for over a year. That's a long-term capital gain or loss taxed at lower rates, currently 0%, 15%, or 20%, depending on your overall income. This difference is why BTCS, quite rightly, tells shareholders to consult their tax advisors. It gets complicated fast.
It really sounds like it, and it sounds like a huge record-keeping burden for the individual. Unlike my stockbroker sending me a neat 1099-B form summarizing everything.
You're absolutely spot on. That's one of the biggest practical hurdles.
The onus is entirely on the investor.
Pretty much. While crypto exchanges are getting better at providing some reports, they often don't capture everything, especially if you move crypto between wallets or exchanges, or earn it through staking or dividends directly. So you are personally responsible for keeping meticulous records.
Of what, specifically?
Your cost basis, the USD value when you acquired each bit of crypto, the date acquired, the date sold or disposed of, the proceeds you received in USD value for every single transaction.
That sounds daunting.
It can be, especially if you're active. This is why specialized crypto tax software has become so popular. It helps automate tracking across wallets and exchanges. And get this, there's generally no de minimis exception for small amounts.
Meaning even tiny transactions matter.
Technically, yes. Unlike some areas where tiny gains might be ignored, even swapping a few dollars worth of one crypto for another could theoretically be a reportable tax event. It's a significant burden, and one that often surprises new crypto investors.
Definitely something crucial to factor in. Okay, so wrapping things up, we've unpacked BTCS's pioneering Ethereum dividend, this Bividend. We've seen how it's designed not just to distribute value, but also strategically to reward long-term holders and potentially counter short-selling pressure.
A multi-pronged strategy.
We explored how this fits into the bigger picture, this evolving landscape of tokenized securities and the future of crypto and finance, weighing the potential benefits against some very real complexities and risks.
Yeah, the hype versus the reality.
And of course, we just highlighted those critical, often tricky tax implications that come with owning and receiving these new forms of digital assets.
This whole deep dive, I think, really shows us that the line, that traditional boundary between conventional finance and the world of decentralized digital assets, it's blurring rapidly.
Yeah, it feels like it.
Companies like BTCS, they're out there charting a genuinely new path, trying to bridge these two worlds, but maybe fundamentally reshape how value gets distributed to shareholders, how companies interact with their investors in this digital age. It's a fascinating experiment to watch.
It really is, which leaves us with a final provocative thought for you, our listener, to chew on.
Yeah.
Will this Bividend model, this idea of paying dividends in crypto, truly become the next big thing for shareholder payouts?
Yeah.
Could it usher in a new era where digital assets are just a standard part of corporate finance, a normal part of investment portfolios?
Or does the inherent volatility we talked about, the still developing regulations around crypto, and those significant tax complexities we just covered, do those present too many hurdles for widespread adoption in the traditional finance world? Will it remain niche?
And regardless of whether it becomes mainstream or not, how might this kind of innovation reshape your own approach? You're thinking about passive income, about portfolio diversification. What new opportunities or maybe new challenges does this convergence of traditional and digital finance present for your own investment journey?